Hi guys, on this module I'm going to talk to you guys or explain to you guys in very vivid detail what the difference is between what happens in an accumulation phase and what happens in a distribution phase. So we're actually going to look at inside accumulation. Okay, so we're going to look right now in this module inside accumulation. So I'm going to show you guys the different phases that happen and how we can identify them in real time. What are some of the nuances, how we can work around this, and everything is labeled pre-hand just to make it short. I would have liked to have done this dynamically. I'm very much a dynamic person, but I couldn't for time reasons. I want this course to be short, engaging, and I didn't want it to be long and drawn out, because that will mean that everyone gets bored and they start going and then that's not great, right? So as a result, I've decided to kind of pre-label everything, and then we can talk about it individually. So I hope you guys appreciate that, and I'm not really copying out of anything. It's just that it makes life a lot easier for you and for me too, right? So I'm actually going to start looking at INVA, right? So this is a stock, all right? So it was great for me to move away from the currency, right, which Forex guys have absolutely loved if you've been just watching the other videos, but just to show you how it works, it's the same in every market. Okay, so it's not really different. And INVA is a great stock. This is a stock that I purchased in the past, right? And it's a stock I'm looking to purchase again, right? It's just, I'm just not ready for it right now, right? And when we look at the PCOM example, PointsCom International was a great trade that I called a couple of actually going back, I think it's almost about a year ago, and it was a great addition to my portfolio, and PCOM has done fantastic. And you'll actually have a look at PCOM and see how it's doing currently relative to its prior lows. Right, so these are actual stocks that I on my watch list and I have traded in the past. Okay, so I'm giving you a very good example right now on how you could work with these stocks. And some of my other great buys over the years have been Take Two Interactive, and if you guys have any chance, just pick up a chart of TTWO. I purchased this at $9 a share and traded this to the immense highs at the time of about $30 a share, and then I repurchased it at $30 a share and took it to the highs of about $70 to $80 a share, where I couldn't do it anymore, right? So but if you look at TTW, it's done phenomenally well over the years, right? So that's just an example of some of the investments that I've done, and my primary resource for doing that has been Richard Wyckoff, especially when I've been dealing with the stock market. So it's really great to have a stock example. Right, so let's take a look at INVA. Right, so this is typically what happens in accumulation. So the asset has been distributional, it's been marked down for a fair amount of time, and we hit what we call a climax. Now, it's very easy to identify a climax. Now, and I say easy because most of the time you will be able to identify it. Now, the tricky bit is that the times when we get a climax and there's something missing in that climax, and that takes us back to the Wyckoff 3 laws. Right, so let's have a look at INVA. So we've been distributing and then we hit the climax here. And how do we identify a climax? Well, that's by high volume. So you can see there's a climax, there's high volume. This is an amazing climax. It's great. Usually when I see climaxes like this, my blood boils. I really get excited. Right? Reason being is that I know that this is a trade that I want to do. The time is always near. Now, talking about some of those nuances, what I always like to do is respect Elliott wave theory. So I always try and establish very, very quickly a 5-wave count just to make sure that I'm actually seeing the climax. Now, a climax comes 80 to 90% of the time after a third wave. So just really grabbing on this here, right? And don't mind where my zero is right now. It's going to look maybe a little crazy, but it's okay. So I'm just going to put things just so I can get this out of the way, right? And I know we're coming in all way 5. So this is like a really good benchmark for me, so I don't get the climax wrong, because it's very easy to see the climax. I could buy the stock at $7, right? $7.33 or where is this actually? Give it a proper line. $7.54. And then say, well, I'm running this, I'm expecting the AR anyway, so I'm just going to buy it at $7.54. But I'll be ignoring the fact that there's probably a greater opportunity for it to come where I can buy that stock at $4.50, right? So why would I want to take it at $7? I mean, you know, for $4.50, there is no way I don't make money from that stock. I'm doubling my money. I'm definitely doubling my money, right? No question about it. So I like to add a little bit of Elliott in there to spice things up. Try and establish a 1, 2, 3, 4, 5-wave count over. If you see a nice clean distribution like this, try and establish that, because it will probably alert you as to where the spring is going to be, which is our next subject. and that's normally the end of wave 5. So again, I'm going to come off Elliott now. I don't want to we do have a course on Elliott waves, so I don't necessarily want to murder this in Elliott. I want to talk specifically about Wyckoffean logic. So what you can see here is that as we hit the climax, we did an AR. Now the AR for me forms the trading range. Now you would notice that some people might say that, well, you get the AR, you're going to get a secondary test, which is going to extend the automatic reversal range. So your trading range would have sat at 1487. But for me, as good practice, I keep the trading range at 1377, because 8 out of 10 times that trading range will be very difficult to beat. So if you want to be a swing trader, right, and you want to maybe just play inside of the accumulation, maybe you want to do a couple of shorts knowing that you're going to get at least 2 secondary tests before this market actually breaks out of the trading range, then you want to put that into perspective, right? So the first phase, right, of accumulation, so that's phase A, right? So remember, markets are not linear, okay? That's all I'm going to keep saying. Markets are not linear, right? So the first part of accumulation is phase A, right? So phase A is where we get the climax and the automatic reversal. That's phase A, because that starts to define the trading range. And actually, if you look at Facebook, right now, Facebook established its trading range. Now, anyone who bought Facebook as it crashed into the lows of $150 a share, well, it's actually now $165 a share. So, okay, so you're making 15 points right now on Facebook, right? And that was a trade that I actually did. And it's not because I want to really carry Facebook now out of the accumulation, but I think for a large cap stock that just got hit by that S&P 500 decline, it was a great time to get involved. All right, so that's just a brief example there of something that I'm not seeing right now, but I actually remember, and you guys can take a look and just see how Facebook developed into its AR and essentially hit that spring. All right, so what we got here is that automatic reversal, and then now we get a pushback where we break the climax low and we do what we call a spring. Now, usually the spring, there's no demand, right? So generally when we get a spring, it's kind of a false action and it acts like a shakeout, right? So normally if you're long here, you panic, you might let the position go on the spring, right? And then it comes back and then you're wishing that you didn't let that position go, right? But the spring is what you want to look out for. So if I see a climax, my next stop is to look for a spring, right? The moment I get a spring, it doesn't matter where I'm buying within that spring. And that's the beauty about it, is that you don't have to rush to buy the stock. You can just calm down and see the spring and then pick it up when we start seeing some more buying just after the spring. So I would have been a happy buy at $5.20 all the way into $6 a share. It would be awesome for me. I would have been gladly buy INVA, okay, Naviva. So it would have been an amazing buy. Right, so that is one thing you got to bear in mind, is look out for the spring, right? And the spring is the beginning of phase B. So your stock is not going to run away. And this is normally the most tumultuous time for traders, because if you look at, we're looking at a weekly of INVA. It took basically from 2008, right, when we established the spring in November. The phase B itself didn't actually end till 2009 December. So it was like a whole year in phase B, and phase B tends to be the longest, right, when we look at it inside accumulation. So most people would have been happy buyers in '08, and they would have cashed out about $13 a share. So you can cash out in the accumulation if you don't have a long-term horizon. But the most important thing is that regardless what your trading time frame is, markets are not linear, right? So no matter what your trading time frame is, right, you would have an opportunity to buy it at those lows and sell it back in the accumulation, because even though this is part of a wider trading range, it is still accumulation. It's still, there is another cycle within it, basically. So it's accumulation, but it is also markup in another cycle, and it's also distribution in another cycle. Okay, so just bear this in mind. Markets are not linear, right? One thing doesn't lead to the next, right? So going forward, the spring showed up very low volume, right, which tells me that the market has been completely shaken out. There will not be a TSO, or what we call a terminal shakeout, in the future, which normally occurs around about phase C, but or the end of phase B, but there will not be a TSO. Normally people look for a TSO, so you'll see people teach and say buy the TSO, but most of the time the spring is the best to buy, because these days the spring normally is cleaned up everybody, so there's no TSO. All right, but we'll talk about the TSO a little bit later on. So moving on, the spring showed low volume, which means that everything was clear. There was hardly any supply coming down anymore. There was no demand here, so this was just the smart money checking out the best prices it could get. Most of the short covering had happened on the climax, so this was the point now where they're preparing to sort of get long in the stock and just shake everybody out. So the volume you're seeing here is just really, really guys in the know, right? There's no one here. The public are largely not going to pick up on this stock. In fact, when I was looking at Innoviva, no one was looking at Innoviva. That's just it in a nutshell. No one cared. It's like, what the hell is that company? They're probably it's just gonna go sideways. So, but what you will learn if you're a stock trader is that these are the stocks that offer up value, right? And these are the guys I like and I look for, right? So going forward, we develop in a phase B, right? And as we go into phase B, notice that there's volumes very low in the stock, and that takes us into phase C. And then we have another secondary test, which is about $7.88. So as we push out of the trading range, we start creating what we call secondary tests. Now, there are a couple of these. So we go 1, 2, 3, 4. Generally, we expect around about between 4 and 6 STs within sort of phase B and phase C. That's generally by my count. Right? And then we develop into what we call the last points of support. So again, it's at these points that, again, I default to Elliott wave, that we tend to see a third wave start to emerge, right? So usually when we can see that step up movement, right, we tend to start visualizing that this market is going to form into some kind of a trend, right? So again, it's nice to kind of establish at this point that we could enter up into a very quick markup. So again, a great buying opportunity is normally at what we call the last point of support, okay, or the LPS, right? Usually within the LPS, we should see a bit of demand, right? In this case, we're showing very low volume in the LPS, right? So it means that investors probably weren't very confident about this stock to kind of even join the composite man here. So everything that was going on here was largely composite, but there were slight spikes of demand, and I always watch out for these, and we can mark them out. So we can see a bit of overly excessive demand sitting somewhere about here, right? And if we look slightly inwards, we see another slight spike sitting over here. So we know that this is the LPS area because it is what I normally call an SOS, or a sign of strength. I always look out for that SOS, right? So just remember that, guys. SOS. I'm going to add that in here. Right, SOS. I always look out for an SOS in that phase C, because SOS is 9 out of 10 times are in a phase C. On the odd occasion, we get within a phase D, but phase D, we're normally above the creek, right? But I always look for my SOS very early on within the accumulation area in phase C. So we got that SOS, right, which popped on in 2010, 22nd of March, and this stock now, we know that the composite man, it was ready to move it. It was only a matter of time because he's already started to buy at what I will call slightly inefficient prices. And also the hedge funds, the other big guys in the know, are now looking at what the composite man is doing, and they're trying to capitalize on that. So this is like a very major thing for me, is the SOS. So I always look out for it. So you will see them across the board, okay? But that's my SOS. So this was the LPS within phase C, and then we popped above the creek, and we started a major markup. And you could be forgiven to thinking that this thing was going to blast. But just remember, guys, markets are not linear, right? So whilst we steamed away into what looked like a markup, it was part of a bigger play. So as you can see, this development now, which was visible, we did enter distribution at some point, right back into the accumulation area, but this was actually just a back under the creek, as larger traders now are now going to impose their will on this stock, and you're going to see how far this thing actually goes. So we come out of the creek briefly, right, which is always expected, and that allowed a lot of potential profit, because that stock, if you were buying it and you followed the instructions anywhere near the ST from $6 to $8 a share, eventually at the top side you cashed out at $21 a share. So it's a really good investment, right? And then we pulled back on the distribution into the creek again, and then we formed a bigger, or what I would like to call a reaccumulation point at that stage, right? So as we move in, we can see the LPS, right? So that was the wider last point of support, and look at the volume, right? So that's the justification right there. Look at how high this volume is, right? And that's because the larger traders who are now sapping up the demand are now available on the playing field, and they're buying at $10.98 a share, slightly more inefficient, but they're not honed in on the smaller frame. They're looking now at the big picture. So now they're buying here, and just look how this thing goes. So when immediately we get the LPS, it is also, this move down is what we call back under the creek, right? So we had an LPS and a back under the creek at exactly the same place, right? And then we push upwards. So now you can see us rise, right? And then we start forming. Now we're now firmly into phase E. We're now very much in the markup phase. So this is the very last LPS. There's hardly anything going on. There's no supply on the downward trajectory. And look at how that demand picks up as we go. So it's rise in demand all the way through. And that takes us to highs where distribution now kicks in. Right? So this is like a longer term distribution of $34 a share. And that's why the big guys were going in here, because what you're looking at is from $10 a share to $30 a share. I mean, it's like 3 times your investment. So if you're buying if you had confidence in the stock to step in at the early days through the phase A, B, and C when the cause was really developing, yeah, it took you a few years to get your return. But once we stepped in, you were in the territory of supernormal profits, right? That's what we call supernormal profits. So guys who are familiar with economics will tell you it's about that. That's what we want. We want supernormal profits. So I'm buying here. My risk is incredibly low on this asset. I would not sell out this stock. You know, again, even if we were to break the spring, I would really reconsider selling that stock. But the truth of the matter is my loss on this investment will be relatively minimal in proportion to my gain. So that's kind of how I look a lot about investments. Is it's about maximizing, right? So I'm not a shy investor, right? So as you can see, this stock boiled away, and then we distributed back down in the accumulation zone, and the process restarted itself. Okay, so again, we can see that demand get in here. So that's the bigger traders now as we dropped back in again. And that was the reason why I was rebuying in Aviva a second time, because I can identify the climax. I can see the, in this case, we just got a secondary test. I can see the AR form, right? And that's my trading range, right? So this is just live and dynamic, right? So that's my trading range, right? And you can see all those tests, and you can see that point here where the demand comes in. So we know that this is pretty big, right? Because that was supposed to be an ST, and if you notice, we didn't get a spring, right? So unlike what happened here, there was no spring. In fact, we formed the AR, right, initially, and then we took off. So we have a few interim STs, but no spring, right? So, and then the market starts to mark up, right? So again, it's all about being flexible with your ideas and being a bit more dynamic, because we're back within the accumulation area of the past. I have to look at it. The markets are not linear. So this could be part of a much larger cyclical play. It could be part of a much wider, this could actually be an entire phase A. So this whole thing could be an AR on a much wider cycle, and this is just part of our ST, right? So this here would be an ST, and then that means that we can develop in here and then maybe push down again, and we might see a much bigger growth curve in this stock in the future. And this is how the S&P 500 grows over years. But then you get all these people, or sometimes I like to say the idiots, excuse my French, who would literally go out there and say that this market is going to collapse, and they start looking at, you know, they are stellar cycles. They're cycles that are going to span years and decades, but we are in a world that desires growth at this point in time. So no matter what happens, some of these stocks are gonna you know, move into oblivion, or they're gonna get acquired by different companies, but there is always gonna be value. Okay, we got to bear in mind that this could be part of a wider long-term play that we are not right now seeing. Markets are not linear. All right, good guys. So hopefully we enjoyed this section of the course that looks inside accumulation. In the next module, we'll look at inside distribution. But hopefully this has started to give you guys a very good picture, or a very good idea of what takes place in accumulation and how you should be getting in on these stocks.